This is our 11th topic of our financial curriculum, values and valuation. Valuation. Entrepreneurs want a high valuation, but not so high that it is hard to raise capital or likely to disappoint. Investors want low valuations, but not too low that the founders and management are discouraged. Value comes from customers. If you have many loyal customers who are willing to buy your product at a substantial economic profit, your company will be highly valued. That means that the value pie is large and investors or other stakeholders will be willing to own a smaller slice. For example, pay a high valuation to participate. Then, if there is a limited market that is highly competitive and customers have many attractive options. One challenge in valuing ventures is that there are no easy formulas given the high degree of uncertainty. The fact that the investments are illiquid, information is hard to obtain, and the contracts between investors and managers are complex. Biggest misconception entrepreneurs have is that they need to get the highest valuation. It is more about what the right amount to be raised, the right team members to have around the table. If you have a high valuation and even reach all your milestone, the risk tolerance for the next stage of investment may not be able to meet the valuation expectation. At each stage, you have to give investors the right incentive to come and join the journey. High valuation can haunt them if market dynamics change. Valuation expectations change. Milestone expectations change. Should focus on right team, right product rather than the valuation. The future value of company is more important than what the ownership is. If you make a successful company, you will have all that money. You need to build on future value rather than value. Further discussing valuation. If your venture capital partner can increase the likelihood and magnitude of success of your company, you should be willing to pay a premium to get them involved. You might even accept a lower valuation from a fabulous investor because having that person involved will increase valuation later. You shouldn't focus only on the price per share each potential investor is offering. What else do they bring to the venture? If they invest, does that signal to the world that you are the industry winner? Can they get you in front of important customers or suppliers? Can they help with the next few rounds of investment and the exit phase? These are the kinds of questions you should ask when thinking about investors and deal terms. The value of a venture is discounted present value of the future free cash flows. Free cash flows are the difference between operating inflows and outflows. Every entrepreneur should have a deep understanding of their business model and the cash flows that will determine how much they need to raise in external capital, when, and on what terms. Further talking about valuations, venture capitalists focus on operating cash flow, but they also use other techniques to estimate value. For example, they might forecast that a successful software company could generate $100 million in annual revenues in 5 years and have a 15% net income margin. Given valuation multiplies in the public market, that company might be worth $300 million, 3 times sales or 20 times net income. For simplicity, suppose the company will need only one round for financing $10 million. What share of the company does the venture capital firm want to own to justify making the investment in the first place? Venture capitalists know that they need to earn high rates of return on successful investments to make up for inevitable losses. A rule of thumb is that they try to earn 50% per year on each investment, knowing that the actual return on the portfolio will probably be less than that. If an investor wants a 50% rate of return in 5 years, you can calculate what the $10 million investment has to be worth then. The answer is approximately $76 million. Talking further about valuation, if the whole company is valued at $300 million, the venture capital firm needs to own a little over 25% of the stock. The basic idea here is to apply a high discount rate to a success scenario in which the company has performed well and is highly valued in the public markets, or as an acquisition target, 1 plus 50%, raised to the fifth power, is highlighted as an example of a high discount rate. Experienced investors would view the scenario as unrealistic. They know that most, if not all, companies need more than one round of financing in a 5 year span. They also know the employees will have a significant share of the company. Most companies grant stock options to employees to get them to join the venture and share the value they create. In this simple example, the venture capitalist might estimate that the employees will own 15% of the company in year 5 and that investors in future round will own 25%. That implies that 40% of the final value, or $120 million, will be allocated to others. That means the venture capital firm needs to own a higher percentage of the equity at the start to account for dilution. If the venture capital firm owns 42% of the initial equity, they will own $76 million worth of stock at the year 5 and will have earned a 50% annual return. If an investor pays $10 million for 42% of a company, the company is valued after the first round at approximately $24 million. This set of calculations is more of a guide than a precise method. The idea is powerful to determine what share of company I need to own at each round of financing. I need to estimate what the company might be worth at some point in the future. I then need to adjust for expected dilution for new financing and options for employees. An entrepreneur might argue that it's unfair for an investor to ask for such a high return of their investment. But remember that the probability that the portfolio company will be a success is low. 60% of portfolio companies fail. A small percentage of companies do very well. If the venture capital firm doesn't own a significant share of each venture to start, they will not earn the returns they need to satisfy their limited partners. The other important point is that the venture capitalists compete for the right to invest in any company. If they offer unfair terms, they won't get any entrepreneurs to accept them. The most powerful tool any entrepreneur can use to get a fair deal is to get more than one firm to be excited about investing. As this curriculum ends, it is important to step back from the extended discussions of financing, term sheets, and valuation and focus on an even more important topic: values. The entrepreneurial journey is difficult. It is easy but dangerous to focus on financial measure of success like the value of shares held at any point. How an entrepreneur behaves matter, particularly during the inevitable period of stress. The one asset we all have is a reputation. It is hard to establish a great reputation and easy to destroy it. We have all read recent stories about leaders creating a toxic culture, or they have taken more than their fair share of the reward from the entrepreneurship, or they have sacrificed family and personal relationships to win the game. That's not what the best entrepreneurs do. Remember that many venture fail, but the only people who get kicked out of the game are the ones who sacrifice their integrity in the process.